This week, the rise of green finance.
What we're trying to do is to have a positive impact in every investment and to future-proof those investments.
2021 is the year of sustainable finance, but how do we make sure that all of this money is as green as it's supposed to be?
No matter how you look at it, it is inevitable. We know the direction is clear, but the road will be bumpy.
The European Union lays out the green standard for bonds, tightening up rules for banks on climate change. And turning money into motion, the story of how one small activist investor took on an oil giant.
We see a real link between the impacts a company makes on workers and society and the community, but also on climate and the environment, on the long-term financial value of these companies.
I'm Danny Berger in London, and this is Bloomberg Green. The rapid rise of green finance has been one of the defining trends of the past few years. There are now more than 600 ETFs that claim to follow ESG principles, but questions remain as to how many really promote sustainability. And with murky definitions, wildly differing strategies, and no global benchmark, it's well worth asking just how green is green finance? Our reporter Alistair Marsh broke it down for us.
Given the signs that climate change requires immediate action, this is the decade. And so we wanted to start by saying, look, let's make some good commitments.
These issues have moved very swiftly from being corporate social responsibility issues or more niche issues within finance to fundamental value drivers.
We will ultimately divest in a company if we really think we're not getting the traction that we need.
Following a record $305 billion of green bond issuance in 2020 and another $500 billion slated for this year, 2021 could be called the year of sustainable finance. Governments and corporates are all in on the act, and every continent has seen green issuance in the last 12 months. And that's just bonds. Almost $300 billion of green loans were issued in 2020, and there are now more than 600 environmentally positioned ETFs. Amid this explosion in green finance, you'd be forgiven for thinking we were experiencing a revolution in money markets. Some believe we are, and that green finance is capitalism's answer to the climate crisis.
Well, there are a lot of positives when it comes to green finance, in the fact that nearly every bank, insurance company, pension fund, asset manager has now made commitments, either under sort of in response to societal pressure, or perhaps because they've done their own research and they see sort of the writing on the wall when it comes to the issues associated with climate change.
But amongst the jubilant, there are also doubters. Accusations of greenwashing are common, and an investigation by Bloomberg Intelligence revealed that many supposedly environmental funds barely differ from their non-ESG counterparts. Regulators are scrabbling to keep up with the trend, including the EU, which released its green bond taxonomy last year. But there are no agreed-upon standards in the US or internationally, and the growth in green bonds issued by steelmakers and oil companies have raised some eyebrows. The question is, how can money flowing into a company or government be green if that company or government continues with other actions that are distinctly anti-environmental? Spanish oil company Repsol issued a €500 million green bond in 2020. The company ring-fenced the funds for efficiency savings, which were covered under its green bond framework, but meanwhile they pumped more and more oil out of the ground.
This market is growing rapidly. There are no common standards and definitions, and therefore one man's green finance is another man's greenwashing. People have compared the ESG or green finance market to a bubble, a hype, and this is the kind of thing that happens when you have loads of money flowing in one direction at the same time. And you can imagine there being incidents of mis-selling, you can imagine people losing a lot of money, and you can imagine people buying things where they thought it was one thing and it was actually something else. The black cloud across the whole market is this idea of greenwashing, that people are exaggerating or misstating the greenness of what it is that they're selling and what it is that they're doing.
Away from tackling climate change, there's another motivation behind green finance: even if global emissions were cut to zero tomorrow, the climate is undergoing rapid warming with average surface temperature up by a degree in the last century. The impacts are already being felt with extreme temperatures in the US, sea level rise in the Pacific, and droughts across much of Asia. Alongside human suffering, these changes are adding risk to assets such as farmland or residential property, putting them at risk of becoming stranded. So green finance is evolving as a more climate-smart place to store capital, away from the risks posed by climate change.
If we're going to have a low-carbon future, coal immediately, we have to rule that out. Lots of oil and gas will no longer be kind of relevant or accepted or appropriate either. And if you're a bank with a lot of that kind of exposure on your loan book, well, you have a big potential risk coming at you. So there will come a moment, a crunch moment, where funding will be withdrawn from these kinds of projects and companies, where you can imagine insurance being withdrawn, and where you have these stranded assets, and you don't want to be kind of there holding the baby at the end.
As hundreds of billions pour into green finance, the question seems to be not whether it's already good or bad, but what its impact will be going forward. Is it just the flavor of the month? Believers promise everything from a green tech renaissance to higher and more resilient returns, whilst detractors level accusations of greenwashing and more wasted years not tackling the root causes of climate change. Rising from obscurity in just a few years, the green finance craze shows no signs of stopping.
So from policing products to products that police themselves, EQT, one of Europe's biggest private equity funds, is diving headfirst into green finance. It's issued $600 million worth of sustainability-linked bonds, but importantly, this debt is tied to specific ESG goals. So if a company EQT owns misses a diversity or emissions target, it will penalize itself and give more money to bondholders. That's a first in green finance, and I'm joined now by EQT CEO Christian Sinding. Christian, first off, thanks so much for joining us. And what really was the thinking behind issuing these sustainability-linked bonds?
The thinking was we wanted to actually give an additional incentive to our teams and the boards of the portfolio companies and the management of the portfolio companies to really drive measurable change. And that's not so easy to do these days because the measuring impact is quite complicated, and connecting that directly to financial results is also complicated. But with these sustainability-linked bonds, we can actually connect targets to, for example, diversity and also the environment. So all of our funds and all of our companies are now committing to the Science-Based Targets Initiative, for example. And then the third element is transparency, a level of transparency that we can deliver.
If I can tease out this idea of having those financial incentives to it, obviously EQT very active in the sustainability space. Why do you need the potential of financial penalties? Why not just do it for the sake of improving these companies and improving the return you'll get out of them?
Yeah, I like the challenge. And we actually don't think of it as penalties, although there's both upside and downside. So we're going for the upside. So we're actually going for lowering the financing costs. So it's something like 10 basis points a year that the financing can actually improve by in terms of its interest rate. And we've also issued actually at the EQT level. So we have bonds at the EQT level. We have multiple bonds now at different fund levels. And what it gives is just an extra incentive. Of course, internally, we also have our compensation systems are linked to sustainability goals as well. So there are multiple layers of this. And of course, from a philosophical point of view, we actually have in our Articles of Association that we're here to future-proof companies and make a positive impact. So all these things together are just contributing to more, accelerated action.
When it comes to investing in companies, there does seem to be this debate that often unfolds that says, okay, it's either you want to stay away from any of the sort of sin companies, you want to invest in already sustainable companies, or you want to invest and buy companies that you can actually enact a change. Obviously, there are a lot of different industries that EQT is involved with. Where do you come down on that debate? What has your experience been?
Yeah, what we're trying to do is to have a positive impact in every investment, and to future-proof those investments. And what we do then is we try to focus on our companies that can either become much more sustainable One example of those is we just invested in Anticimex again after owning it for a long time. Anticimex is a big pest control provider. And in the past, what they were doing was, driving around in trucks and spraying chemicals. What we're doing with that company is actually digitizing it, both making the product much more sustainable and actually upskilling the workforce to a more digital solution. So really driving a sustainability change in the company and hopefully also the industry. You can also have, really sustainable companies like renewable, infrastructure providers that we own several of and are actually working on a public to private right now in Spain. And those are already very sustainable. And our job then is to accelerate that sustainability transformation or development. What we do, though, is, of course, we stay away from things that are, let's say, very, very black, like coal or, certain parts of the carbon industry or, gambling and other kinds of things. That's kind of the easy decision. The harder ones are the ones in the middle where we have to drive a positive transformation.
Christian, thank you so much. Really appreciate it. That's Christian Sinding, CEO of EQT. The EU has released its green bond standard, which outlines what is sustainable debt and what's plain old greenwashing. Our Europe correspondent, Maria Tadeo, will have the details next. This is Bloomberg Green.
In New York, I'm Jennifer Zabasaja, and here's everything you need to know in Green this week. Japan says individuals will need to make the greatest changes to energy consumption to meet the country's climate targets. Households will need to curb greenhouse gas emissions by 2/3 over the next decade from 2013 levels. That's the deepest percentage cut of any sector. Japan strengthened its 2030 climate goals earlier this year, a step towards net zero emissions by 2050. Also, Fidelity International has warned companies if they don't take sufficient action to combat climate change, the asset manager will vote against management at shareholder meetings. The $787 billion investment firm has announced new policies requiring companies to manage their environmental impact, reduce their greenhouse gas output, and make disclosures about their emissions. China didn't finance any coal projects through its Belt and Road Initiative in the first half of this year, the first time that's happened since the plan was launched in 2013. And according to the International Institute of Green Finance, more than 70% of all coal plants built today rely on Chinese money, followed by investment from Japan and South Korea. However, Belt and Road funding for green projects was also hit during the pandemic. And that's your Green Brief.
Jen, thank you so much. Now, the EU has set out a green bond standard and tighter measures on banks to better reflect the risk climate change poses to the financial system. The aim is to bring the world of finance in line with its ambitious goal to make the region carbon neutral by 2050. For more, Bloomberg's Maria Tadeo joins us in Brussels. Maria, thank you so much for joining. Now, what is the EU exactly trying to achieve when it comes to green financing?
Right, Danny. So on paper, they say this is a new type of green financing for a new, greener economy. Of course, a lot of this goes into this big push, as you mentioned, to cut down emissions and become climate neutral. Now, there's two pillars to this. One, of course, is just the practical aspect of this. The European Union is really trying to scale up this market, to make it bigger, to make it more liquid, because they will have to issue so much money in the next few years. You know, Danny, from next year until 2026, we have the European Commission tapping markets for about 150 billion euros a year. 30% of that will have to be green bonds. So clearly they do have an interest in making this an attractive liquid market. The other issue coming to play here, of course, is this global competition that we're seeing to get money from ESG. You know, we've seen a lot of investor appetite into that market. The European Union does believe that if they're able to get the legislation first, if they're able to make the rules very clear and move away the risk of greenwashing, which is the biggest concern for investors, they'll be able to dominate this market. And I would argue, you know, they do have a good argument here, because if you look at the figures from 2020, half of the money that was issued for green bonds was issued in euros. So they clearly are trying to completely dominate this market. But as you know, Danny, there's been also good pitches coming from the UK and the United States on that front.
Okay, so do we have any sense as to what these products will look like exactly and who's going to be issuing them?
Well, Danny, there's two things here. One is if you're an issuer, the European Union will allow you to tap into the European green bond space if you're based in the EU, but also if you're not based in the EU. So you can see that they really are trying to make this global. Now, secondly, they do say that this is going to be an option for every type of issuer. So you're looking at financial companies, but also non-financial companies, governments, and institutions that may want to finance themselves through green. And what is also interesting here is that they're coming up with what they call the European Green Bond Standard. Now, this is a document that companies will have to inform and will have to provide. It's voluntary, but again, the thinking is that you do want to be super transparent to attract money. And essentially what you do is that you prove that there is no risk of greenwashing and that the money really is going to finance green projects that will be in line with European goals.
Maria, thank you so much for this. That's our Bloomberg Brussels reporter, Maria Tadeo. Now, one asset manager which has built a strategy for investing in green bonds is Robeco. It invests in bonds issued by governments as well as corporates with aims to create a positive environmental impact at the same time as returns for investors. Across all of its investment, it has 160 billion euros in ESG integrated assets. We're joined now by Lucian Peplembos, Robeco's climate strategist. Lucian, first off, thank you so much for joining. And when it comes to green bonds, I mean, there's been explosive growth. The market's worth now more than $2 trillion. How do you account for all of that appetite?
Indeed, clearly, there's a strong appetite in the market for investing in green bonds. And that has to do with climate change and the low carbon transition being a long-term trend that no matter how you look at it, it is inevitable. We know the direction is clear, but the road will be bumpy. There will be disruptive changes. But long-term, the low-carbon transition, the energy transition will take place. Now, green bonds is a relatively easy place to start with because they are well-structured packaged products that investors seek exposure to.
Okay, so it's an easy place to start, but how of an effective place is it to start? Can it really make a difference?
It can, and of course there's a lot of debate about it. There's concerns about greenwashing, and I think those risks are real, and that's exactly why there are standards being developed in the market.
So when an investor is buying this, or really any sort of investing strategy that has to do with sustainability, what sort of returns should they expect? Or is it more about just doing good and maybe the alpha comes later down in the road?
No, alpha is and continues to be part of our fiduciary responsibility, so it comes at first place. However, we think that if you devise it cleverly, it can be really combined with sustainability. Take, for example, carbon footprint reduction. You can go a long way in reducing footprints of portfolios without any significant impact on risk return. So it's really about a clever approach to combining these different elements. And then, of course, we also believe that certainly on the longer term, but also already on the shorter term, if you integrate sustainability data in your investment decisions, you actually make better informed decisions. So actually, it can also be a source of alpha.
So, okay, company is one side of it and corporates. What role do investors have in pressuring governments to be less reliant on things like coal?
Government policy is key. Luckily, in the last year, we have seen a huge step up from several governments when it comes to net zero commitments. Now we're at a stage that we can say 70% of global emissions and 70% of global GDP are committed to net zero. However, that's by 2050. The key gap is action now, because when we look at 2030, the United Nations concludes in their stocktaking that all the government policies together around the world will only lead to 0.5% of emission reduction by 2030, whereas we need halving of emissions. So the ambition gap is huge. Now, and this is where governments need to step up prior to 2030, operationalize their long-term commitments into real policy action.
Lucian, interesting stuff. Thank you so much for joining us. That's Lucian Peplembos, climate strategist at Robeco. As companies experience increasing green demands from the outside, some are also feeling the pressure from within. You can't talk about green finance without activist investors, and we'll be discussing their rise next. This is Bloomberg Green. From Bloomberg's headquarters in the City of London, I'm Danny Berger, and this is Bloomberg Green. Now, we've heard from the people making finance greener, but what about the people using their money to change companies for the better? The story of sustainability has also been the story of the rise of the activist investor. One such firm, Engine No. 1, says a company's performance is greatly enhanced by the investment it makes in workers, communities, and the environment. And this year, they took on one of the biggest polluters in the world. The firm became known for taking 3 board seats in Exxon to speed up the company's transition. Sarah Rappaport has the inside story on a small fund with $272 million in assets under management and how it took on the oil giant with a market cap of more than $267 billion.
It was the David versus Goliath story. Activist investor Engine No. 1 waged a war with oil and gas giant ExxonMobil and won. It gained 3 board seats, something that would not have happened without the support of big investors BlackRock, Vanguard, and State Street. In a statement, BlackRock said, "We believe more needs to be done in Exxon's long-term strategy on reducing climate risk." At the same time, Exxon was particularly vulnerable to this sort of pressure.
Exxon has this vision of the world where fossil fuels are profitable in the long term, and it sort of has refused to commit to zero out emissions, but that really stands in contrast to European rivals and other companies that are moving in a different direction.
Moving in a different direction, towards net zero, is the main goal of Engine No. 1. Where other, bigger hedge funds had failed, Engine No. 1 managed to effect change with capital worth just $50 million. We spoke to CEO Jennifer Grancio about the campaign.
From an Exxon perspective, our campaign at Exxon, led by Charlie Penner at Engine No. 1, was about making sure the board had the right capabilities to understand how to manage every aspect of the company, including how the company remains a great company through the energy transition. So I guess I would say about the current news cycle that we look forward to the new directors joining the board and the company managing for the future, acknowledging some of the changes and transformations that have to happen there. And if I step back, we built Engine No. 1 specifically because we see a real link between the impacts the company makes on workers and society and the community, but also on climate and the environment, on the long-term financial value of these companies.
But it's not just Exxon. Fresh off the firm's successful campaign, they're launching a new ETF to keep pressure on big public companies on ESG.
One thing that we can do at Engine No. 1 is we can do an economic and impact-oriented proxy campaign and an activist campaign like what we did with Exxon. And we launched the VOTE ETF. There's a little clue in the name there. And we gave it the ticker VOTE. We launched this ETF because it's a way for people to stay invested in these big public companies over time. And then we, as the manager, will vote very actively.
Shareholder activism may be increasingly a way for investors to turn up the heat on companies. Engine No. 1 founder Charlie Penner told Bloomberg that if you can get Exxon to change, everybody else in the industry has to listen.
That's it for this week's edition, but keep the conversation going. Follow us on Twitter @Climate. I'm Danny Berger, and this is Bloomberg Green.